In this section, we'll explore the different ways to calculate depreciation expense. Let's begin with the definition. Depreciation expense is the amount deducted from gross profit to account for the reduction in value of a fixed asset due to age or usage. It's a method for allocating a fixed asset's value to expense ratably over its estimated useful life. Depreciation is the process of allocating the cost of a fixed asset over its useful life. As we say, it's the fate of most assets to become expenses. Let's look at what causes depreciation. One cause of depreciation is physical wear and tear. Take, for example, a milling machine. Another cause is technological obsolescence. Consider a computer. Newer models offer more power and features for less money. According to Moore's law, computing power doubles every 18 to 24 months. A third cause is market obsolescence. For example, a stamping mold used to create a car door. It may be physically sound and not technically obsolete, but it becomes useless when a new car model is introduced. There are several methods used to depreciate fixed assets. The first method is called straight-line depreciation. It's calculated as cost minus salvage value divided by useful life. Let's use the example of an automobile. The car has a useful life of 5 years. It's cost $30,000 and its salvage value is $2,500. Here's how we calculate it. 100% of the asset is depreciated over 5 years, using the same depreciation rate in each of the 5 years. 100% divided by 5. That means 20% per year. The depreciable amount is $30,000 minus $2,500, or $27,500. $27,500 times 20% equals $5,500 in annual depreciation expense. Here we have a depreciation table. The first column is the net book value. In year 1, it is $30,000 to start. The second column is the current period depreciation expense, which is $5,500. The accumulated depreciation, a contra asset account, is $5,500 at the end of year 1. In year 2, we start with a net book value of $24,500. That is $30,000 minus $5,500. The depreciation expense for the second year is $5,500 again, the same for each year. The accumulated depreciation is $11,000. That's $5,500 for each of 2 years. Each year has $5,500 in depreciation expense, as can be seen in the table. Accumulated depreciation goes up each year by that amount with ending book value of $2,500, the salvage value. A second depreciation method is known as double declining balance depreciation. It charges more depreciation in early years, reflecting the fact that some fixed assets depreciate more in early years. That would be true for a computer. Here's the formula. Cost less accumulated depreciation times the straight line depreciation rate times 2. Now let us see how that works. We acquire a computer for $30,000. The useful life is 5 years. The straight line rate is 100% divided by 5 times 2. Or 40%, that's right. The first year, depreciation is 40% of original cost. Salvage value is not part of the calculation except that we cannot depreciate below the salvage value. Here is the depreciation table for the computer. First year depreciation expense is $12,000. The book value after year 1 is $18,000. In year 5, the depreciation expense is $1,388 because we cannot depreciate below the salvage value, $2,500. Notice how front-loaded the depreciation expense is, $12,000 in year 1 and just over $1,000 in year 5. Sum of the years digits depreciation is another accelerated depreciation method where more depreciation expense is taken in the early years and less in the later years of useful life. The formula is cost minus salvage times the depreciation rate. Here we start with N, the useful life of 7 years. n times n plus 1 divided by 2. 7 times 8 is 56. Divided by 2 equals 28. That's the sum of the year's digits. The rate in year 1 is 7 divided by 28, or 25%. There are two ways to arrive at the sum of the year's digits. In this example, we're using 7 years of useful life. Method 1, add up the digits for n, the number of years, 7, 6, 5, 4, 3, 2, 1. That equals 28. Method 2, n times n plus 1 divided by 2. 7 times 8 equals 56. Being divided by 2 equals 28. Try it with 10 years. 10 times 11 equals 110. Divide by 2 and you get 55, just like summing 1 through 10. Here we have a color printing press at a cost of $300,000, a useful life of 7 years, and a salvage value of $18,000. In year 1, we have a remaining life of 7 years. 7 divided by 28 equals 0.25. That's the depreciation rate for year 1. In the second year, it's 6 divided by 28, or 0.214. By year 7, it's 1 divided by 28, or 0.036. We've divided our sum of the year's digits, 28, and allocated depreciation accordingly. Notice, year 1 depreciation is 25%, and year 7 is just 3.6%. The columns in our table are cost minus salvage value. That gives us the depreciable amount. The depreciation rate, for example, 25% in year 1. Then depreciation expense, $300,000 minus $18,000 equals $282,000. Times 25% equals $70,500. Accumulated depreciation is $70,500 in year 1. Net book value is $229,500. In year 2, depreciation is $282,000 times 6 over 28. That equals $64,284. In year 7, we use 1 over 28, or 0.036. This method is front-loaded, more depreciation early on, less in later years. Here we have yet another method of depreciation. It is known as units of production depreciation. This is used when an asset is depreciated based on estimated units of production. For example, a milling machine estimated to last 6,000 hours. We depreciate it based on usage. Another example, an aircraft engine. After a set number of hours, it must be rebuilt. So, depreciation is based specifically on hours of use. Back to our example. The milling machine costs $50,000. Salvage value is $5,000, so the depreciable amount is $45,000. Divide that by 6,000 hours, we get $7.50 per hour. Here's the depreciation table for units of production. In year 1, the machine was used for 1,200 hours. 1,200 times 750 equals $9,000. Net book value is $41,000. Year 2, 1,100 hours. Times 750 equals $8,250 in depreciation expense. Accumulated depreciation becomes $17,250. Net book value, $32,750. Each year, we multiply hours used times $7.50. In year 7, usage may have exceeded 253 hours, but we cannot depreciate below salvage value. So we use a plug number. 253 hours times 750 equals 1898. Final accumulated depreciation is $44,998, leaving a residual value of $5,002. Like all depreciation methods, the useful life is an estimate.